Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, April 14th, 2023. And what I'm going to do in this video is a super brief update on the equity markets. From the look of the board, meaning the comments section on the site, I think it's safe to say we're certainly seeing some a pretty strong sentiment shift. There's all kinds of sentiment indicators out there. The AAII bull bear ratio or survey. There's the put to call ratios, but it's a small sampling pool, but we'll see. I just wanted to say that it seems that bullishness has really ramped up lately, and I view that as a contrary indicator. Now, look. Sometimes that happens. Sometimes bullish extremes, you see the market has tremendous momentum and it carries. So we'll see. I'll let you know if my views change. I'm just going to go over the technicals here real quick, as I told you I would. That 13.2-ish level right there on NQ. That's recent trading range. It was support shelf right there under here, and then it's this recent trading range, and we're at the top of it again. So we'll see. If a solid break, you start to get away from it. We had one little whipsaw down below, and then one little whipsaw up above. We're back in it today. Typically, when you're at the top, next stop is the bottom, then the top, then the bottom. I mean, this is it doesn't last forever, but it's super simple to recognize a range like that, and that's the MO. And then, as I said, typically the longer these ranges go, I view it as energy building like a coiled spring. And then so if you get a definitive break to the upside, definitive break to the downside, definitive means anything other than a whipsaw that fails for shortly afterwards, because that's usually pretty bearish if it's a false breakout to the upside, and bullish if it's a false breakout to the downside. So anywho, if you're, we're going nowhere. Bulls, bears aren't winning. I wanted to make a point. I did answer that in the comments section lately. Like I said, I've rarely recall an issue or a time in recent months, at least, not longer, where there's been just excessive bullishness on the board, and I'm struggling to try to understand it. My response to some of the comments. This is 2 weeks ago. That's April 3rd, almost 2 weeks ago. We'll go back to March 31st. That's where I think I went with on these stats. So there's 2 weeks ago today, the 31st of March. And right now, as of this point in time, we are up a whopping 0.75%. You'd think we're up 30% in the market in the last couple weeks. Based on the comments. So, nothing's changed from my point of view. And again, we need these sell signals. We need this trend line to break to further solidify the bearish case. It hasn't happened yet. QQQ, admittedly, QQQ has been where my positioning for the index shorts, and then I'm about to go over the rest of it, everything else out there. I never ever would put all my money in long or short the index and not have other offsetting potentially, hopefully offsetting positions, i.e. diversification, asset allocation. So I'll get into that in a second. We're going to look at just a couple of things, and including gold stocks, and which I still very, very much like: gold, silver, and the miners on the short side. All right, this is there's that same candle. Is it March 31st? Yep. And we'll just turn off all the lines, and again, this is where I struggle to understand a lot of the comments. We're, as of right now, as of today, we are down 1.14%. And even after, what it is it's, you get these one-day rallies, and all it is a rally in a trading range. So even through yesterday's highs, with that big rally, or relatively good-sized rally in QQQ, we were still down 0.62% at the highs yesterday from where we were again 2 weeks ago. So I don't know. We see different things. I'm seeing a market that's not going up anymore, and yeah, given that it's not going down, and I get that and you can make a case that they're buying all the dips. It's not going down, but it's not going up. It's anybody's game. So let's just see which way it breaks, and then if and when the technicals start to change, I will communicate my thoughts if my outlook changes. But right now, I see one of the best looking setups, and Today will be a pretty interesting day because you had J.P. Morgan, and of course we know that the game is rigged. They are the casino, they are the house. Washington and the big banks, Goldman Sachs, J.P. Morgan. It's a revolving door between the two. That's where all the Washington folks come. Most of them come out of, and the ties there. So we know the big banks will, the house will always win. And we'll watch that. And what I'm getting at is, let's see how the market closes today. The Qs opened down, but then they went positive early in the day. They bought it up, thinking that J.P. Morgan's good news is good for Apple and Microsoft and Amazon, and then they faded that. And again, it's a non-event. We're only down 0.4%, so nobody's won this battle yet. So we'll see where we go. All right, let's move on to other things, and we'll continue to watch the market. We'll watch stocks like Apple, which have need to break these support levels, just like the market. Beautiful, beautiful uptrend line. All right, let's move on to quick update on Treasury bonds. As I said, lately that's been both a pure play short as well as an indirect hedge to my swing short positions on the equity markets, and that is, I've got it here somewhere, ZB. There it is. Nice. Just a beautiful, beautiful resistance zone right up there. I mean, look how many reaction highs, major reaction highs, drops on each one. And this TA 101, could I guarantee you at the time it would play out? No, but with a high probability, with negative divergences, very well defined resistance, and then you take shots like this, and you have your stops somewhere above, because if they break out and then they start burning through the divergences, that's bullish. But that's not what happened. And so far it's been a nice trade, and I just want to point out we're coming up to my first price target now, that 130, 144. You always want to cover a little bit below the actual support level that a reaction is likely, and I could easily see us carry down here to that 129 level as well, though we'll probably get a reaction off that initial target first. So so far so good there. So we're really, like I said, in the last 2 weeks, technically the Q shorts are up, not by much, because the Qs are down a little bit. And I wanted to show you, lumber. Pointed out lumber just last week. It was right here on April 10th. Yeah, the April 10th video pointed out that nice big divergent low. That's a 60-minute chart, and the fact that we had just, which is bullish, recovered that this was a former support level, so we had that little false breakdown. And as I said, fewer things in trading investing are more bullish than a failed breakout or breakdown and then followed by a recovery. So that's what we call a bear trap. Bears short the break of support. They don't pay it, those, I guess, that would short a breakdown with positive divergence, and then once you recover, it's a pretty strong thing. And this also, by the way, guys, other than just a trade update, it's showing you what's happening with that ridiculous lag time in commodity. Everyone hanging on the CPI report, which is dated information by the time you get it. You're looking back, driving in the rearview mirror if you're trying to trade off that report. So I'm just showing you here in the last since end of March. So that's perfect, because that's when your CPI is released on a monthly basis, and so this showed falling commodity. Lumber obviously affects the housing market, home prices, and it bottomed literally that day. And so far, since the beginning, first of the month, commodities through today's highs have rallied. That's 14% to the button on today's high. And so, and again, I did this yesterday. I'm not going to go through each and every one. Coffee, sugar, crude oil, everything up. And so, if you want to get ahead on that vicious cycle or negative feedback loop between commodity prices, and which are inflationary, interest rates, real or perceived, and then the stock market, that's this loop. So far, commodities have been moving up and have increased pretty sharply since that last softer than expected. Well, expected by Wall Street analysts, but you could have just looked at the general charts of commodities and your general commodity index and seen that throughout the month prices fell more than the 0.3 or 0.1% increase in the month to month on CPI. Oh, and I wanted to give you some. I added a couple target zones, swing target zones. That's T1. That's a zone. There's a if it carries up there, 50150, we'll call it 500, and then 558 right there. But I'm going to give you one more line right now. You probably see the first resistance level come in right about here, give or take. And I see that as it was support there. We went through there a few times, kind of grabbed it there, reaction high there. We slice through it, so it's not a hard number, but we're coming up on what's probably the first resistance level, and if not, then you have one right, even better, right about here. Why is that better? Better defined support there, reaction high there, reaction from below there, broke out, back tested it successfully. I got a reaction candle right there, reaction high there, big green candle there, and then we broke it. And so that really nice target where if we get up there soon, you might want to book profits, recycle back in on a pullback, or kind of see where things are going. If I'm still correct on my equity market views, which I know have drawn a lot of ridicule on the homepage, I'm looking at a reversal, big, still 20-30% drop in the equity markets. At some point, if I'm correct, and it starts to pan out in the coming weeks to months here, it'll probably start gradually, but then begin to snowball. And what I'm getting at is if you do get into that, and I'm not updating lumber at the time or any of the other commodities, you can get in that hard selling phase where you have a lot of margin calls and forced selling, and therefore a lot of things get sold down with the equity markets because folks that might be long Apple and Bank America and all that may have some lumber or whatever else, crude oil, and they're getting margin calls and they're getting forced selling. So just keep that in mind. But as of now, we're not even close to that. In fact, we're in a very resilient uptrend. The market refuses to go down so far. But like I said, once the market decides to make a turn in a bear market, the history shows it's usually pretty quick, and you don't want to stay too late to the party. These other turning points have been, you had a period, there was a turn, you did have some consolidation for about a week or so there, and then the big drop. Here it just was going up one day, and one day it was going down, and that was it. And then here a little bit of consolidation, and so we'll see. And again, we start going up, it starts to really chip away, at least in my opinion, at the case to be swing, have swing and trend short positions. Okay, and let's keep this short. Let me go to the precious metals. Start out here with gold. I'm going to look at the futures. Love this chart. Big, clean, bearish rising wedge pattern. Nice, plenty of distinct reactions on that uptrend line. We've been diverging, just like we had positive divergence here. We just like we shorted gold there on that trend line break, and silver rode that down, milked most of that, got long and bullish at the bottom, and got admittedly. But again, I always say this to me, and I've said this a lot in the past. I define in my trades and trading, there's a big difference between being early and being wrong. And in a bear market, things move fast. I've been pretty precise so throughout the last year or so on calling these turns and getting in right before something ripped or dropped. And in this case, with gold and the semiconductors and the equity markets, I view as being a little bit early. And the difference is early, you can, let's say you short gold, you start shorting gold here. And it doesn't play out, and you're looking for it to go down to here, and that doesn't happen right away. As long as you don't get stopped out. When I'm wrong, that's I enter a trade too early and it exceeds any reasonable stop or my stop threshold, and I stop out for a loss. I am wrong. I've lost money on that trade. Being early means exactly just that. that it didn't pan out right away, but it stayed within any reasonable stop parameter. Great example is, I used earlier in the year, was it the financials or energy sector or both? We had trades on those. Financials was a good one back here. I gave a short entry and I gave 3 targets, 1, 2, 3, and I updated this throughout. We hit the first target. There was our sell signal on that steep uptrend line break. Hit the first target right away. But then as I updated, we went on to make just marginal new highs, and based on the risk reward ratio, the financials went up about 8%, and the target down here was about 21%. So that didn't exceed any reasonable, at least a 2-to-1 RR stop risk reward ratio. And so it's just it was not even early. The first target was hit, and that's where typically you take profits, especially you had some divergence after you expect a bounce, and then would have been a reshort here. You can see all the trend line breaks, and so it went on to hit that third and final target, and then it just hit it again. It hit it again. It hit it again there, and that's a big level now. I don't have an opinion or a position on the financials right now. Wait and see what happens after the giddiness of those earnings today. Again, JP Morgan, we all know it was very, very well telegraphed in advance that the big banks were a beneficiary of these bailouts that came in place of Silicon Valley Bank and the financial instability and Credit Suisse collapse and all that, where assets flocked. Everyone was worried, pull their deposits out of the regional banks, put them into the big banks. So anyways, we'll see what happens. I just want to point that out, that if I don't update this, and whether it's 3 weeks or 3 months from now, and you see 30-40 break, it's get out of Dodge time for the financials, big banks, the big financials. Okay, I'm going to skip the euro because I just did that yesterday. You can check out my analysis there on that video. Back to the charts of gold. Just again, I keep referring to the setup in the on the Nasdaq 100 as a one of the best looking bearish setups I've seen in a while. This is a nice setup in gold with that uptrend line right there, bearish rising wedge. Measured target, you take the widest part of a wedge, that would give you your measured target. Take us down here probably at least at 1932. I'm just eyeballing it. And then I'm going to get to the miners in a second. Gold, yes, I know some of you don't trade futures. You look at GLD. Covered that again yesterday. In yesterday's video, I said it would be nice to see a gap down today in gold. That would give us a beautiful little island reversal pattern. What is that? I encourage you, when I throw these terms out, if you're not familiar, use Google. Google search island top. And I pointed this one out back here. There was an island top. They are major reversal candlestick patterns. It consists of 3 parts. 2 parts really, or 3. You have a gap up after. By the way, you don't look for them in the middle of nowhere. You want to find them after a prolonged uptrend. There was a little island top right there as well. And this is called an island cluster top. When you gap up, you have a cluster of candles separated by gaps on both sides. But after a prolonged uptrend is really where you want to look for them. And you have the same thing on the bottom. You have an island. That was an island reversal bottom right there with the candlestick gap down, separated, a candlestick separated by gaps on both sides that mark that bottom. So either way, look, you know me, I've been longer term bullish on gold since it bottomed a few years ago, and until recently I just kind of had a more what I call a soft pivot based on my outlook on the euro and the stock market, and the fact that it didn't mesh because gold, the euro, and the stock market tend to be positively correlated. I'm just looking right now near term, and I just wanted to say that we do have we still have the positive divergence on the GLD daily chart. Let's see, do we have a bearish PPO crossover today? The day's not over, but we do. There's a bearish PPO crossover, and let's just see where this goes. So anywho, trying to give you a target. I'd say, let me turn on this level here. I'm just focused. I trade futures usually, but if you need targets here, align them with the futures. But I'd say somewhere in there, maybe a pullback to about that 180 or so. Possibly more with an island a little doji up there too. I forget the name for that pattern when you have the doji is the island. Shooting star, maybe one of those. And we'll see if that pans out or not. Silver, SLV, you usually get more bang for your buck when you are long silver during a bullish uptrend in gold in the precious metals, and you usually get more bang for your buck shorting silver on the downside. It tends to follow its big brother but move in larger percentage gains. Very steep uptrend line, which has now been starting to be taken out, and you've got a little bearish PPO crossover pending. Extreme overbought conditions. The last time silver was this overbought was just, and we're in a bull market, by the way. That is characteristic of a bull market. I don't, what I'd love to see, if the charts align, I'd love to see a pullback to back test this bull market or bear market downtrend line from the big correction. Longer term, we're in a bull market there, but that would be a nice re-entry down here. You have a big cluster, that little trading range somewhere in there, and so that's all I'm looking at. And if we do get that, we could put in a bigger divergent high. We don't have divergence, we just have a bearish, we have overbought conditions and a pending but not yet bearish PPO crossover. Last time we had a bearish PPO crossover in silver, a high level was what I call a clean one. We had one right there that put in a major top, so there could be more to it. Let me give you the futures real quick, and then I'll move on to GDX, and I think I can wrap this video up. SI, silver, there we go, been diverging. Like I said, divergence is not a sell signal, it is a condition, an indication that a trend reversal is likely, and that is a 110% sell signal right there. It's possible that something happens today and we reverse back up and it's a whipsaw. I always say this, when you're trading intraday charts, the shorter the term time frame you're trading, the quicker it's going to get you into a position on a breakout on the long side or a sell signal on the short side. But you have a higher chance of it being a whipsaw, so you can wait to the end of the day. The downside to waiting for a solid daily close, or let's say this is a 2-hour candlestick chart, 120-minute candles, is the longer you wait on a breakdown, with especially something with a lot of hot air. A lot of hot air in silver right now. By the time you get that confirming sell signal, you can be halfway or almost all the way to your first target. My first target is right here. I see a little support here that could get a little bounce at about 25 and a quarter, but this is a big level here, right here. And the bulls are probably, I can almost guarantee they're going to step in and buy here. If you're looking for a near-term target, that was a major top right there, and we broke out recently right here and back tested. See that little area of consolidation? So they'll probably come in and buy at least the initial tag there. If it goes, of course, that's going to have more bearish implications, because that means this whole thing here will be a failed breakout, aka bull trap, and that's probably going to send silver down here. But I always trade, if I'm trading silver or GDX, which I'm going to get to next, or gold, I watch them all together collectively. I put the highest weighting on gold, the charts there, but I most certainly watch the technicals on silver, and very much the US dollar and the euro. I watch those as well, because they are a huge, there's that strong inverse correlation to the US dollar and gold, and then which is also a positive correlation with the euro and gold and silver. So there's that big divergence. Last time we had divergence like that was right about there, and you got that. And last time we had a divergent low was right there, and you got that. All right. Silver, I already covered that. Last one, GDX. Okay, so interesting. Yesterday, if you recall back here, bullish falling wedge, breakout. It gave you 4 price targets. And 1, 2, 3 was hit. I was very clear when T3 was hit, told you personally, taking profits, looking to short the metals, said that's for a swing trade, and we hit. I give you 2 price targets on the pullback, so T1, T2, and then we put in a divergent low, and I said that at the time that would take us up to T4. Well, I started to soften my outlook around here, based on everything I've been covering, including today with the the outlook of the euro and everything else in the stock market, and did that kind of soft pivot. So that was a case of maybe getting out of the longs a little bit early, But one thing I've learned in the past, when I put these final targets, I list multiple targets because the final target's usually where I think the end of the run is going to be, and that's usually where I pivot. I told you based on the charts are dynamic, meaning they're evolving day by day, and that's why we have negative divergence there, and that's why I didn't continue to hold out. That's why I preferred to turn around and sell the longs on the bearish rising wedge breakdown and then short it. But I just wanted to point out all the better now. So if I like the GDX short right here a few weeks back, a month or so, whatever it was, I like it much better now because we made a perfect tag of my T4. That T4 level is created back and updated, I guess, where I drag the line if I move anything or change it. It says updated back on January 30th, 2023. And we hit it to the button. And then you have a nice clean uptrend line right there, breaking down. PPO is rolling over at high levels. Looks like a bearish PPO crossover is likely and imminent. And you got a big green hill. That's swing trading trends right there, trend trades. Well, last time we were short was during that red hill. And the time before that we were long was right there, and then we were long, or at least I was, through most of this. Some of you might have held on to that. Congratulations, but time to get out of Dodge, in my opinion, right now on the metals. So, yeah, it's like I said, it looks like these have been traditionally risk-off assets, but the market, the Fed, everything's topsy-turvy right now. As I said, the Treasury bonds is a great example. We've kind of seen a return to the risk on, risk off thing. It's been on and off, hit or miss lately. I saw an article the other day that the 60-40 trade is back in vogue now. All I'm trying to say is, the Fed has distorted the financial markets so severely with extensive price manipulation, quantitative easing, quantitative tightening, artificially low interest rates are too long. What I'm getting at is trade everything on its own charts and own technicals. I will acknowledge past correlations, but I put a higher weighting on current correlations. In other words, that whole, whether it's gold in the US dollar, treasury bonds in the stock market, crypto in the stock market, risk on, risk off. I got those trades out to you today. I'm sure most of you probably thought I was crazy putting Bitcoin and Ethereum on as official trade ideas today, but that's what it is. Take them or pass them. Obviously, I tell you, always take the trades that you believe in, that align with your analysis. It's not a follow me site. And that's it. So let's look for that high level bearish PPO crossover. That means the histogram is going to go red, which I just parked, and it could give us another downtrend tradable swing trade pullback in the mining stocks. Okay, I'm going to wrap this one here in under 28 minutes, and those are the things that I wanted to get out to you. And again, the takeaway is diversify, 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 whether it's your 401k, whether it's your trading account, asset allocation, different securities, even within your equity arena. You don't typically want to be all tech stocks or all financials or all REITs, whatever it is. I didn't mean to make a smiley face there. I'm just showing you that the more diversified you are, it smooths out the bumps. And so in the last few days at least, where the equity market was going up yesterday and treasuries were going down, that's an offset, and it really helps you kind of to stay in the game and stick with your trades, stay with your trading plan. Don't ever stick with a losing trade just because it's losing trade and you want to get your money back. If it exceeds your stop, whether it was predetermined or something's changed in the charts, my trading plans can be flexible. I'm not a rigid trader, but I won't stick with something that starts to, once the charts convince me that I was wrong, then that's where I'll either hard stop out or just scale out and move on to the next one. All right, I'm going to wrap it up here, get the video out to you guys. This has been Randy Finney with Right Side of the Chart.